Technical analysis helps us identify trading opportunities using actions of the traders through charts, patterns, and indicators. So, technical analysis helps us to forecast the price movement of a particular stock based on our individual study. So, in this module, we will be diving deep into different charts, different chart patterns, and also be studying indicators which help us simplify the process of analysis of different charts. So, technical analysis involves the study of the charts of the different companies. It represents the actions of the investors on a particular stock in a specific time frame. Technical analysis helps us to figure out good entry and exit points based on the stock price of the particular company. We study the chart and identify patterns which help us reach to a conclusion as to whether to buy or sell a stock. In technical analysis, we are not concerned as to why the stock is either bullish or bearish, but rather we focus on the how. So, while performing technical analysis on any company, there are a few assumptions that we follow. First one being markets discount everything. So, technical analysis believe that everything from a company's fundamentals to broad market factors or even market psychology are already factored in the stock price of any company. The second assumption is focus is always on how and not why. So, a technical analyst would not be interested in questioning why the stock is either bullish or bearish as long as he or she knows how the price will react or reacted to that particular event. The third assumption is prices always move in a trend. So, all major moves in the market are an outcome of a particular trend. Once the trend is established, the prices move in the trend direction only. We'll be studying this in detail further down the line. The fourth assumption is history tends to repeat itself. This happens because the market participants or the traders consistently react to price movements in a very similar way every time the price moves in a certain direction. So, out of the different types of charts, traders have most commonly been using the line chart, which consists of lines, the bar chart, which consists of bars, the candlestick chart, which consists of candles. We'll be focusing more on the candlestick charts. Before we dive into understanding candlestick charts, let us first understand how to read a single candle. So there are basically two types of candles. One is the green candle and the other is the red candle. The green candle represents the bullish traders dominating the bearish traders. And in case of the red candle, the bearish traders are dominating the bullish traders. So let us take an example to understand a single candle. The first point we study is of high. High represents the highest price on a particular time frame of a chart. Upper shadow. So the upper shadow connects the high point to the closing price of the candle in case of a bullish candle, and high point to open in case of a bearish candle. Close. Close is the final price at which it trades during regular market hours on a given day. The real body, which is of rectangular shape, connects the opening and the closing price. Open. Open is the opening price or the price at which the stock first trades when the market opens for that particular day. Lower shadow connects the lower point to the open in case of a bullish candle, and in case of a bearish candle connects the low point to the close. And the last thing which we study is low. Low represents the lowest price on a particular time frame of a chart. It is very important to choose the correct time frame of a chart based on the trading strategy you apply. Like for example, in case of scalping, which is a trading style that specializes in profiting off very small price changes, generally study the 1 minute range chart. In case of intraday trading, which is also called as day trading, where the buying and the selling of stocks happens on the same day, study the 5, 10, 15, 1 hour chart. In case of holding a stock or a commodity for a few days, we study the hours or the daily chart. In case of a long-term trade, we study the daily, weekly, or the monthly chart. One must not stick to a particular time frame of a chart, but compare the similar time frames and then, based on your study, draw a conclusion of whether to buy or sell the stock. Now let's have a look at some single candlestick patterns. The first one is the Marubozu candle. So the word Marubozu means bald in Japanese. So since this candle does not have any upper and lower shadow, therefore it appears bald. In case of a bullish Marubozu candle, open is equal to the low and high is equal to the close. Let us have a look at the doji candle. A doji candle is a candle without a body and just the tail. The opening and the closing of a doji candle can be at the same price or a similar range. The doji candle can be an indication for a trend reversal. Essentially, there are three types of doji candles: gravestone, long leg doji, and dragonfly. A gravestone doji is a bearish pattern that suggests a reversal followed by a downtrend in the price action of that stock. It can be used as a sign to take profits in a bullish position or to enter a new bearish trade. The long-legged doji is a candlestick that consists of long upper and lower shadows and has approximately the same opening and the closing price. This pattern shows indecision and is the most significant when it occurs after a strong advance or a decline in the price trend. A dragonfly doji can occur after a price rise or a price decline. The open, high, and the close prices are very similar or match each other, and the low of the period is significantly lower than the former three. Therefore, this creates a T shape. The appearance of a dragonfly doji after a price advance warns of a potential price decline. A move lower in the next candle can provide confirmation of that particular downtrend. The spinning top. So these candles have a really small body, which indicates that the open price and the close price of the candle are quite close to each other. The upper and the lower shadow are almost equal. Hence, neither the bulls nor the bears are able to dominate the situation. So the spinning top essentially conveys indecision, as both the bulls and the bears are not able to influence the market as they would like it to be. The hammer candle. So this candlestick indicates a bullish reversal trend. The long shadow of the hammer candle is about 2 to 3 times the size of the real body. The color in case of a hammer candle does not really matter. These candles indicate a potential price reversal which then moves to an uptrend. The price generally starts moving up following the hammer candle. However, wait for the following candles to confirm the following uptrend. The hanging man candlestick. So this candlestick indicates a bearish reversal trend. The long shadow is again about 2 to 3 times the size of the real body. The color in case of the hanging man candlestick doesn't really matter. So the hanging man is a bearish reversal candlestick pattern that occurs after a price moves upward. The long lower shadow of the hanging man shows that the sellers were able to take control in a partial way for that particular trading period. This particular candlestick is just a warning for a reversal trend. The following candles should confirm the following downtrend in order to place a trade. The inverted hammer. So this candlestick indicates a possibility of a reversal in trend. The long shadow of this candle is about 2 to 3 times the size of the real body. Again, in case of the inverted hammer, the color of the candle doesn't really matter. The inverted hammer candlestick formation occurs mainly at the bottom of downtrends and can act as a warning of a potential bullish reversal pattern. The sellers try to push back the prices to the opening price of the day. However, with increasing prices, it shows that the bullish traders are testing the power of the bearish traders. Since we are now able to identify the candlesticks, let us have a look at some chart patterns. The first one being the bullish engulfing. So the bullish engulfing is a two candlestick pattern which suggests a possibility of a trend becoming bullish. In case of a bullish engulfing pattern, a bearish candle is always followed up by a stronger bullish candle. It is a candlestick pattern that forms when a small red candlestick is followed by a large green candlestick, and the body of which completely overlaps or engulfs the body of the previous day's candlestick. The second candle completely engulfs the real body of the first one without regard to the length of the tail shadows. Now let us have a look at one example of a bullish engulfing pattern. So as you can see, the green candle or the bullish candle engulfs the body of the bearish candle, and you can see the start of an uptrend. Bearish engulfing pattern. So it is a two candlestick pattern which suggests a possibility of a trend becoming bearish. A bearish engulfing pattern is seen at the end of some upward price movement. It is marked by the first candle of upward momentum being overtaken or engulfed by a larger second candle, indicating a shift towards the lower prices. This pattern has greater reliability when the opening price of the engulfing candle is well above the closing price of the first candle, and when the closing price of the engulfing candle is well below the opening price of the first candle. A much larger down candle shows more strength in the downtrend than if the down candle is only slightly larger than the uptrend candle. Now let's have a look at one example. So as you can see, the bearish candle engulfs the bullish candle in this case, and then it is followed by a strong downtrend. Tweezer tops. It is a two candlestick pattern which suggests a possibility of a trend reversal. The first candle in the tweezer tops is of the same color of the trend. A tweezer topping pattern occurs when the highs of the two candlesticks occur at almost exactly the same level following an advance in the downtrend. If shadows exist, their shadows should be of equal or similar length. Now let's have a look at one example. So as you can see in the tweezer tops, the first candle is of a green color, meaning a bullish candle, which is part of the bullish trend. After the tweezer top, you can see a strong downtrend, which indicates a trend reversal. Tweezer bottoms. It is a two candlestick pattern which suggests a possibility of a trend reversal. A tweezer bottom chart pattern is just the opposite of a tweezer top chart pattern. This particular pattern occurs when two candles which are back to back occur with very similar lows. Since we've already studied the tweezer top chart pattern, we'll be just brushing through this chart pattern through an example. So as you can see in the example, the first part of the tweezer bottom is a red candle, meaning a bearish candle, which is a part of the bearish trend, which is then followed by a strong bullish trend, indicating a trend reversal. Three black crows. It is a three candlestick pattern which suggests a strong reversal trend. It is a bearish candlestick pattern which is used to predict the reversal of a current uptrend. The three black crows pattern occurs when bears or the bearish traders overtake the bulls or the bullish traders during three consecutive trading sessions. The pattern shows that there are three bearish long-bodied candlesticks with short or no shadows. In a typical appearance, the bullish traders will start the session with the price opening modestly higher than the previous close, but the price is then pushed lower throughout the session. In the end, the price will close near the session low under pressure from the bearish traders. Now let's have a look at one example. So as you can see, the uptrend is followed by a strong reversal which results in a downtrend with the help of a 3 black crow pattern. The 3 soldiers pattern. So it is a 3 candlestick pattern which suggests a strong reversal trend. The opposite of the 3 black crows pattern is the 3 white soldiers pattern, which occurs at the end of a bearish downtrend and predicts a potential reversal uptrend. This pattern appears as a 3 long-bodied green candlesticks with short or ideally non-existent shadows. The open occurs within the previous candlestick's real body and the close occurs above the previous candlestick's close body. 3 white soldiers are simply a chart pattern indicating the reversal of a downtrend, whereas the 3 black crows indicate the reversal of an uptrend. Now let's have a look at an example. So in this chart, you can see that post the downtrend, you can see a small uptrend going with a 3 white soldier pattern. Next are gaps. A gap occurs when the opening price of a stock is far above or below the previous closing price with no trading activity in between. There are essentially 2 types of gaps: gaps opening up or gaps opening down. They are further categorized into common gaps, breakaway gaps, runaway gaps, and the exhaustion gaps. Common gaps occur frequently and are when the opening price is slightly different from the prior closing price. A breakaway gap occurs when the price moves above a significant resistance area or below a significant support area on the gap. Runaway gaps occur during a strong trend and show that the trend is still strong enough and appear generally midway in the trend. Gaps in general don't provide much information and hence we are covering just the basics of it. Let's have a look at 2 examples to understand gaps. In the first example, we are seeing an example of the gap opening up. You can see an uptrend following the gap opening up. In the second example, we can see an example of a gap opening up as well as a gap opening down. Trends. So basically, there are just 3 types of trends: uptrend, downtrend, and the side trend. As the name suggests, they are quite easy to understand. Let us look at examples of each. In the first chart, you can see an example of an uptrend where the prices are moving in an upward direction. In the second example, you can see an example of a downtrend where the prices are moving in a downward direction. In the third chart, you can see an example of a side trend where the prices are stable across a channel. Trend line. In a trend line, our aim is to connect 2 or more tops or bottoms of different candles. A trend line helps us to determine the current direction in the market prices. We should always remember that the trend is our friend, and identifying this trend is the first step in the process of making a very good trade. We should most often trade in the direction of the current trend itself, unless and until you want to take up a very risky trade. Uptrend. In an uptrend, each successive high and low is higher than the ones found earlier in the trend. Uptrends are often coincidental with positive changes in the market for either that particular stock or the overall market itself. Let's take an example to understand how to draw trend lines. So before we start analyzing the charts, I would like to state a few pointers. First of all, always use a candlestick chart, and in addition use a logarithmic scale, because the movements or the changes in the price would be percentage changes in case of the logarithmic scale, unlike the linear scale where the changes would be based on the price of the stock. Always analyze the chart based on your understanding and only then confirm it with indicators. Avoid relying purely on indicators. Also, during your trading period, avoid reacting to every signal or an indication in the chart, as many of them can be false signals. And in such cases, avoid panicking as well if any trade goes in the opposite direction or in a direction where you did not want it to go. Stay balanced and make logical decisions. And one of the most important methods or process is to always maintain a logbook or a diary and record all your trades. Let's identify how to draw a trend line and also understand its application. So here at the first glance, you can clearly see that there is a possibility of an uptrend. So I confirm it by drawing a line. So I click on draw, I click on lines, I take the option of line, I start connecting the lows of different candles. So as mentioned earlier, the aim of the trend line is to connect either the highs or the lows of at least two candles. So here you can see that there is an uptrend which is going on in this particular stock. You can also identify that at this junction or at this point when the candle broke this uptrend line, there's the start of a downtrend as well. So with this, you can place trades and make profits accordingly. Downtrends. In a downtrend, each successive high and low is lower than the ones found earlier in the trend. Downtrends are often coincidental with negative changes in the market for either that particular stock or the overall market itself. Let's take an example to understand how to draw downtrends. Let's take a look at an example of a downtrend. So here I simply start from this candle. I connect the lows of at least two candles. And here you can see that there's a downtrend, and following the downtrend, there's a start of a side trend. So with this, you can identify the different trends which exist in the market. And again, beyond this point, you can observe that a small uptrend has also started. So this is how you identify the different trends which exist in the chart and place trades accordingly. Side trends. A sideways trend is the horizontal price movement that occurs when the forces of supply and demand are nearly equal. This typically occurs during a period of consolidation. A sideways trend is also known as a horizontal trend. Let's take an example to understand how to draw side trends and how to identify side trends. So let's look at an example of a side trend and also where to place trades when there is a breakout from a side trend. So I've drawn a horizontal line which is connecting the lows of four different candles, here, here, here and here, which states that there is a side trend at this particular point in the chart. At this particular junction, the candle with a gap has broken this side trend and there's a start of a strong uptrend. I've also confirmed it with a trend line, and as you can see that this uptrend exists until this point where this red candle has broken the uptrend with three crows, which states that there is a breakage of an uptrend and the downtrend has started. Pennants. Pennants are similar to flags in terms of structure. The volume at each period of the pennant is also very important and should be studied carefully. Inside the structure of the pennant, the volume should be on a lower side, and then following the breakout, the volume should increase. Many traders look to enter new long, meaning buying positions, or short, meaning selling positions following a breakout from the pennant chart pattern. A symmetrical triangle is a chart pattern characterized by two converging trend lines connecting a series of sequential highs and lows with similar slopes. The price is forced to either break out or break down. A breakdown from the lower trend line marks the start of a new downtrend, while a breakout from the upper trend line indicates the start of a new uptrend. The target price should be equal to the distance between the first high and the first low of this structure in the respective trend. The stop loss for the triangle pattern is often just below or above the breakout point. The flag pattern is used to identify the possible continuation of a previous trend from a point at which price might have shifted from the original trend. If the trend resumes in the same direction, the price could increase rapidly, making the timing of a trade advantageous. Even though flags suggest a continuation of the current trend, it is prudent to wait for the initial breakout to avoid a false signal. A wedge pattern can signal either bullish or bearish price reversals. In either case, this pattern holds three common characteristics. First, the converging trend lines. Second, a pattern of declining volume as the price progresses through the pattern. Third, a breakout from one of the trend lines. The two forms of the wedge pattern are a rising wedge, which signals a bearish reversal, or a falling wedge, which signals a bullish reversal. The rising wedge. The trend lines drawn above and below the price chart pattern can converge to help a trader anticipate a breakout reversal. While price can be out of either trend line, wedge patterns have a tendency to break in the opposite direction from the trend lines. Falling wedge. When a stock's price has been falling over time, a wedge pattern can occur just as the trend makes its final downward move. The trend lines drawn above the highs and below the lows on the price chart pattern can converge as the price slide loses momentum and buyers step in to slow the rate of decline. Before the lines converge, price may break out above the upper trend line. Resistance. As the name suggests, resistance is something which stops the price from rising further. Resistance occurs where an uptrend is expected to pause temporarily due to a concentration of supply. It can also be studied using different technical indicators rather than simply drawing a line connecting the highs of different candles. The resistance level is always above the current market price. You can think of the support level as the floor and the resistance level as the ceiling. So in order to understand the use of resistance better, let's take an example. I've pulled out a daily chart of Tata Motors and I'm using the Zero the Kite platform. You can perform similar analysis on either charting or also TradingView or any other resource which is available on the internet. So let's get started. So initially I've drawn a horizontal line which is called as the resistance line by connecting the highs of two different candles. Remember, while drawing a resistance line, it is compulsory that you have to at least connect the highs of two different candles. So as we have learned that resistance is something which stops the price from rising further. You can observe in this chart that this resistance line is preventing the stock price to go further up. However, at this particular junction, you can observe that this candle has broken the resistance line. And hence you can see a positive uptrend, a strong uptrend going. It can also be clubbed with the tweezer bottom. So this is one example of resistance. You can enter at this point and continue until there is an uptrend. Support. Support level is something that prevents the price of the stock from falling further. Support level is the level at which buyers tend to purchase or enter into a stock. It refers to a stock price that a company rarely goes below. The support level is always below the current market price. So let's take a look at an example of a support line. So I've pulled out a chart of Tata Motors again. So in this case, the horizontal line represents the support line. So the support line or a level is something that prevents the price of the stock from falling further. So as you can clearly observe in this chart, the stock price of Tata Motors has been trying to fall below this support level multiple times, but has failed in doing so. However, at this particular junction, you can see the candle was finally able to break the support level, and hence there was a strong downtrend following the support line. So in case if you are placing a trade based on either the support level or the resistance level, it is very important to study the volume at that particular junction as well. So in this example, let's take a look at the volume. So in studies, you can add the volume chart. So as you can clearly see that at the beginning of this downtrend, there was a very strong volume bar, indicating that there was a lot of bearish traders which invested at this point. Now next we look at is the head and shoulders pattern. It is one of the most reliable patterns in technical analysis. A head and shoulders pattern is a chart formation that appears as a baseline with three peaks. The outside two are shorter in height as compared to the middle one, which is the highest. A head and shoulders pattern predicts a bullish to bearish trend reversal. The head and shoulders pattern forms when a stock's price rises to a peak and subsequently declines back to the neckline. The neckline can be defined as a level of support or a resistance found in the pattern that is used by traders to determine good entry points for the trade. The profit target should be the difference between the high and the low of the pattern, and the stop loss should be slightly above the right shoulder. The opposite of a head and shoulders pattern is the inverse head and shoulders, which is also called as a head and shoulders bottom. Once the final shoulder in this pattern is made, the price heads upwards towards the neckline before it finally breaks out. The most common entry point is a breakout of the neckline with a stop loss slightly below the right shoulder. The profit target in this case is the difference between the high and the low of the pattern. Saucer pattern. A saucer, also called as the rounding bottom, is a technical chart pattern that signals a potential reversal. They usually form at a stock's support level. The decline in the price should make a lowest point. It will then start a consolidating phase which turns the momentum from bearish to bullish before reversing course and then finally breaking out above the neckline. The volume can be an important indicator of a potential saucer formation since it will typically be lower when the lowest point of the pattern is reached and then will increase with momentum. Cup and the handle. A cup and a handle is a technical chart pattern, and as the name resembles, It resembles a cup and a handle, where the cup is in the shape of a U and the handle has a slightly downward drift. It is considered a bullish signal extending an uptrend and is used to spot opportunities to go long, meaning to buy shares. Generally, cups with longer and more U-shaped bottoms provide a stronger signal. We generally should avoid cups with a sharp V bottoms. Ideally, the cup should not be overly deep. Avoid handles that are overly deep also, as handles should form in the top half of the cup pattern. The volume in this case should decrease as prices decline and remain lower than average in the base of the ball. It should then increase when the stock begins to make its move higher up to the previous high. A profit target is determined by measuring the distance between the bottom of the cup and the pattern's breakout level and then extending that same distance upward from the breakout. The inverted cup and the handle. It is just the inverse of the cup and a handle pattern, and one should follow the same guidelines as mentioned before, but just in the inverted direction. Now next we move on to the indicators which help us in identifying how the charts are moving and their price movements. We will be studying different types of indicators which help us in different aspects of observing or understanding technical analysis. The first being trend indicators. These indicators help us analyze whether a market is moving up, down, or sideways over a specific period of time. It is a lagging indicator, meaning it is a financial sign that becomes apparent only after a large shift has taken place. The second is the mean reversion indicator. This indicator measures how far a price swing will stretch before a reversal may occur. It is again a lagging indicator. The third indicator is the relative strength indicator. It measures the oscillations in buying and the selling pressure. It is a leading indicator. A leading indicator helps us to predict and forecast future events and trends in charts and their price movements. The fourth is the momentum indicator. It is again a leading indicator which evaluates the speed of price changing over a period of time. The last indicator that we are studying is the volume indicator, which may be leading or lagging depending upon the situation, and it quantifies whether bulls or bears are in control of a particular situation. Exponential moving average, or the EMA. The EMA is a type of a weighted moving average which helps us to identify price trends over a specific period of time. As compared to a simple moving average, EMA, or the exponential moving average, gives more importance to the recent price data. Exponential moving averages are designed to see price trends over a specific period of time, such as the 50 or 200 days. Let us understand the application and working of moving averages. So simply put, moving averages give you the average price movement of the stock for a given time frame. So let's add this indicator to our chart. Click on Studies, we type in moving averages and we select the right option. We click on Done, and here you get the moving average line. So when the candles are above the moving average, there is an uptrend. Similarly, if the candles are below the moving average line, there is a downtrend. If in case the candles break the moving average line, there is a possibility of a reversal. So there are three types of moving averages: simple, weighted, and exponential. So simple moving average is where the average price movement is calculated simply on simple averages. So in this case, longer the time period of the simple moving average used, the more the indicator will lag to react to these trends. Hence, in such cases where a quicker indicator is required, or when we are trading for short durations or short terms, weighted or exponential moving averages make much more sense. So, both these indicators use different calculations to come to the same conclusion, but in simpler terms, they give more emphasis on the recent price data and hence they are faster in reacting to these trends. So, depending on the requirement, you can use a different time frame for the moving averages. Let's say, for example, 10 to 20 days will be sufficient for short term trading. 50 days time period is good for mid term trading, and 200 days for the long term trading. So when you click on studies and then click on moving averages, you get the option of the type. You can either select simple, exponential, and weighted as well. Similarly, you can type in the period or the number of days for the moving average to be considered. So one such example of a combination of an indicator is using two SMAs or two simple moving averages. In this case, we use two simple moving averages line with different time intervals. So I already have a 50-day simple moving average line. Let's add one more with a shorter duration. I click on moving average. I type in, let's say, 20-day period. I choose a different color. Let's say, for example, black. And I click on done. So remember, irrespective of the time frames you have chosen for the two simple moving average lines, whenever the shorter time frame line crosses the longer time frame line, like for example here where the shorter time frame is crossing the longer time frame, the trend or the price starts moving in the direction of the shorter term line, meaning there's an uptrend in this case. Similarly, when the black line, meaning the 20-day SMA, crosses the 50-day SMA from above to below, there's a possibility of a downtrend. So you can use this indicator as a combination and then place trades accordingly. Like for example, if I were at this place or at this junction, I can see that the shorter time simple moving average is crossing the longer time simple moving average. So I would have entered at this position and would have waited until the uptrend existed. Bollinger Bands. They were developed by John Bollinger. There are three lines that make the Bollinger Band. A simple moving average, which is the middle band, and an upper and lower band. I'll explain the use and the working of the Bollinger Bands in detail through an example. Let us now study the Bollinger Bands and its application in real-life market situations. So the Bollinger Bands are composed of three lines. The first one being the middle line, which is also called as a simple moving average of a fixed time period. The time period generally considered is of 20 days. In addition to this, we have the upper band and the lower band, which completes the Bollinger Band. So a common approach when using Bollinger Bands is to identify overbought or oversold zones in the market. So to understand this, let's take two examples. The first one being here. So when the price of the asset breaks below the lower band of the Bollinger Band, prices may perhaps fallen too much and are due to bounce back towards the moving average line. On the other hand, there could be a situation where the prices break above the upper band and the market is perhaps in the overbought zone and again will look for a pullback towards the moving average line. Another additional approach or a strategy which is used with Bollinger Bands is of the squeeze strategy. So let's take an example to understand this. So here we can easily identify that the price of the asset or the stock is consolidating because the upper and the lower bands are getting closer together. meaning the distance between the upper band and the lower band is very small. This means that the volatility of the asset has decreased, meaning the volume or the number of shares that are being traded has decreased. So, after a certain period of consolidation, the price often makes a larger movement or a larger trend in any one of the directions. So, in this case, here you can see that there is a breakout at this point, which indicates that there is a strong uptrend. But there can be many false signals like this one as well. So you need to compare the volume at that particular point to understand the strength of these trends. So as you can see at this particular point or a junction when the breakout is happening, the volume is at a very large level as compared to the other volume chart. So you can clearly identify that there is a possibility of a strong uptrend. So you can maybe enter at this position and go long until there is an uptrend. So this is a very good application of the Bollinger Bands. Although I would recommend you all to not rely on indicators but use them in addition to your own study or own analysis of the different charts. RSI or the Relative Strength Index. So this index or the indicator was developed by Mr. J. Wilder Jr. It is a momentum indicator which helps us to identify bullish and bearish price momentum. When the RSI is above 70, the stock is usually considered in the overbought zone and in the oversold zone when it is below 30%. Let us now study the RSI or the Relative Strength Index and understand its application in the real market scenario. So RSI is one of the most popular momentum indicators. It is plotted on a scale of 0 to 100 and the time period considered is of 14 days. So this time period of 14 days is applied by most of the professional traders or the experts and is considered to be as the most efficient when compared to other time periods in case specifically of RSI. So as I mentioned earlier, traditionally, when the RSI has a value above 70, the stock is considered to be in the overbought zone or the overbought region, and a trader might look to exit this particular position. Similarly, when the RSI value goes below 30, the stock is considered to be in an oversold region, and any trader might look for buying opportunities in that particular stock because the stock price will be lower comparatively. However, these conditions, which I just mentioned right now, become very subjective to each trader, and hence it reduces the efficiency of the RSI indicator. Like, for example, let's say a trader entered correctly or at the correct time in this particular stock at this particular point. So he might have entered at around RSI value of 50 or 55, let's say, until there was a strong uptrend, and when he or she, the trader, observed that the RSI value is 70, the trader might have considered to exit the position according to the traditional RSI values. However, as you can clearly observe that the stronger uptrend started beyond the point of RSI value 70. Therefore, these traditional values of RSI might be confusing. One very interesting application of RSI is something that I've learned from Malkan's view. So Mr. Vishal Malkan devised his own set of rules for the effective use of RSI. So he states that whenever the RSI value is below 40, consider the stock to be in a bearish region or a zone, and hence place only selling trades or the short trades. Similarly, when the RSI value is between 40 and 60, the stock is considered to be in the sideways region, and hence just simply observe the stock and don't immediately act on it. Beyond values of 60 is where the real fun starts. Beyond values of RSI 60, Vishal Malkan states that the bullish region of the stock starts. So one can enter in this position and hold the stock and place profits until the uptrend exists. So, like for example, as already mentioned, when the RSI value is between 40 and 60 is where the sideways market or the sideways stock existed. Similarly, when the RSI value was below 40 is where the downtrend existed. And I've already mentioned one example of the uptrend or an example of how to enter a stock. I'll also add a link of the website Malkan's View if you wish to get to know more about Mr. Vishal Malkan. Moving average convergence divergence or the MACD. So the MACD is a momentum indicator which helps us to identify good buying and selling zones based on crossovers or divergences. Let us now understand MACD, which is the moving average convergence divergence indicator, and understand its application in the real market scenario. So MACD is a trend following momentum indicator which consists of two lines, the MACD line and the signal line. So as you can see, if I open the settings of this indicator, there's the MACD line and the signal line. So the MACD is of black color in my case and the signal is of red color. MACD line is calculated by subtracting the 26 period EMA or the exponential moving average from the 12-day period EMA. Similarly, the signal line is a 9-day exponential moving average or the EMA. The signal line performs the function of a trigger as to when buy or sell in a position. So because of the time period difference between the MACD line and the signal line is slightly on a slower side to react to the trends in the stock price. So MACD, as you can see here, is often displayed with a histogram, which graphs the distance between the MACD and the signal line. So if the MACD is above the signal line, like for example in this case, the histogram will be above the baseline of 0. Similarly, if the MACD line is below, for example here, the signal line, the histogram will be below the signal line. So one can use the histogram to identify regions of bearish and bullish trends. I am a big fan of this particular indicator. I have been using it for quite some time now. So I'll explain my process of how I identify good MACD or good chart positions. So I particularly look out for charts or stocks whether both MACD and the signal line are below the baseline or the zero line. So let's take this example of the HDFC chart. So here at this particular point, I first identified that it's a tweezer bottom. Then I waited until the MACD line crossed over the signal line in case where both these lines are below the zero level. So at this particular point, I entered this stock or I bought some shares. I waited until the uptrend existed. So you can get an indication as to when to exit a particular trade, again based on the MACD and the signal line. So as you can see at this point, the MACD line is crossing over the signal line again in the opposite direction, meaning the downward direction. So this is where you can exit a trade. However, there can be a lot of false signals, like for example here. So it is advised or it is better to wait until there's a confirmation of a particular trade and then only exit or place trades in any case. Generally avoid stocks or charts where the MACD line and the signal line are close to the baseline. So here there's a side trend going on in this particular chart and hence avoid such situations. Also, I would personally recommend to avoid trades or placing buying trades when the MACD and the signal line are above the value 0, because there always can be a possibility of the stock reversing in just a couple of days or a couple of candles. ADX. So ADX is a trend strength indicator. It is based on the moving average of a stock price. ADX is plotted as a single line with values ranging from a low of 0 to a high of 100, each range signifying a certain trend strength. So the ADX value ranging from 0 to 25 indicates an absent or a weak trend. A value ranging from 25 to 50 indicates a strong trend, and ranging from 50 to 75 indicates a very strong trend. Similarly, an ADX value ranging from 75 to 100 indicates an extremely strong trend. So let us now study the ADX indicator. So the ADX indicator is used to quantify the trend strength. It helps the traders to identify whether a particular signal in a chart is a false signal or a correct signal, meaning a signal which we can consider to make trades on. So trading in the direction of a strong trend reduces the risk of the trader and also obviously increases the profit potential. Therefore, ADX helps us a lot to achieve this particular intention. So ADX is plotted on a scale of 0 to 100 and is non-directional. The indicator is usually plotted along with two other lines. In my case, the green and the red line, where the green line is a directional movement indicator which is positive, and the red line, which is again a directional moving indicator, which is negative. So generally, when the green line or the positive DI directional indicator is above the negative directional indicator, which in my case is the red line, there is an uptrend. Similarly, when the negative DI or the directional indicator is above the positive directional indicator, there is a downtrend in the stock. So generally in charts, look out for positions where the green line is above the red line. This ADX line, which is black in color in my case, shows the trend strength. So the direction of this line, of the black line, does not really matter that much, as it does not show the direction of the trend, but it purely shows the strength of the trend. So as I've mentioned earlier, when the ADX value is between 0 and 25, the trend is considered to be very weak. When it is between 25 and 50, the trend is considered to be strong. Similarly, between 50 and 75, the strength is considered to be very high in case of the trend. And when the ADX value is above 75, the trend is considered to be extremely strong. So, traders might consider or might observe the ADX and look out for buying options. Like for example, a trader might want to enter at this position where the ADX value is 25 exactly and the green line is crossing the red line, meaning the uptrend is about to start. So as combined with tweezer bottoms, the green line is crossing over the red line and one can enter at this position and wait until the uptrend exists. And similarly exit at this particular location where the green line is crossing over the red line. So this is a very useful application and can help indicators look out for buying opportunities. Ichimoku cloud. So this indicator was developed by Goichi Hosoda, a Japanese journalist, and this indicator helps us to identify the momentum and the direction of the trend. It is composed of 5 lines, 2 of which comprise a cloud, where the difference between the 2 lines is shaded by red or green color. The cloud is a key part of the indicator. When the price is below the cloud, the trend is in the downward direction. And similarly, when the price is above the cloud, the trend is an uptrend. So let us study the Ichimoku cloud which looks very daunting at first, but in reality is very simple to understand. So the Ichimoku cloud is a collection of technical indicators that shows support and resistance levels as well as momentum and trend directions. So it might look very confusing. However, it's very simple to understand and use. So let's first start with understanding what makes up this indicator. So first we have is the conversion line and the baseline, which is of blue and red color in my settings. So the conversion line is a 9-day period moving average line and the baseline is a 26-day period moving average line. These two lines help us in signaling good entry points for the trade. These lines are calculated a bit differently as compared to the traditional moving average line and hence will look different. Next we move on is to the lagging span. So the lagging span helps us to understand the strength of the price movement or the trend in the stock. So let's say for example, here the distance between the lagging indicator or the lagging span and the candles is quite large. Therefore, the market is considered to be in a strong trend. Similarly, in cases where the lagging span is closer towards the candle, the trend is considered to be as weak. Let's look at the cloud now. So these shaded regions are known as the cloud. The cloud is a key part of the indicator. One thing to remember is that whenever the price is above the cloud, the trend is up or there is an uptrend. Similarly, whenever the prices are below the cloud, it is considered to be as a downtrend. Avoid investing or placing trades when the prices are inside the clouds.